The warning from the King of Capital. Welcome to Crypto Stand, where we analyze the foundational shifts that will define the future of finance. Today, we are decoding a message, a profound warning, from the single most powerful financial institution on the planet, BlackRock. Larry Fink, the CEO of this $10 trillion asset manager, has not been subtle. In boardrooms, at global summits, and in his letters to investors, he has been consistently signaling the next great evolution of markets, the tokenization of everything. This isn't just a casual prediction. It is a declaration of intent from the king of global capital. He is warning us that the era of traditional stocks, bonds, and real estate as we know them is ending. A new era of tokenized, blockchain-based financial assets is upon us. But here is the part of the warning that almost everyone is missing. This technological leap, this move to tokenize what some analysts estimate to be a $600 trillion global market of real-world assets, will shatter the old financial rails. The current system cannot handle it, and this is where the warning becomes critically important for us. A new settlement layer, a new bridge asset, will be required to handle the immense liquidity and transactional volume of this tokenized future. While the world listens to Fink's vision, we at CryptoStan have been analyzing the infrastructure being built to support it. And all signals, from technological readiness to regulatory clarity, point to one digital asset being uniquely positioned to serve as the backbone for this revolution, XRP. This isn't about hype. This is about decoding the blueprint for the largest market transition in history. BlackRock has issued the warning. Today, we reveal what it means for XRP, decoding BlackRock's prophecy, the $600 trillion tokenization tsunami. To fully grasp the magnitude of what is coming, we must first decode Larry Fink's prophecy. When the CEO of BlackRock, the steward of over $10 trillion in assets, repeatedly states that the next generation for markets, the next generation for securities, will be tokenization, it is not a casual observation. It is a strategic directive. It is a financial equivalent of a tectonic plate shifting beneath our feet. What is tokenization? In simple terms, it is the process of creating a digital representation or token of a real-world asset on a blockchain. This can be anything: a share of a company like Apple, a bond issued by a government, a deed to a piece of real estate, a bar of gold, a piece of fine art, or even future revenue streams from a musical artist. By tokenizing these assets, they become programmable, divisible, and can be traded and settled almost instantaneously, 24/7, anywhere in the world, without the traditional army of intermediaries. The market size for this revolution is almost incomprehensibly large. When analysts and institutions throw around figures like $600 trillion, they are estimating the total value of global assets that are ripe for tokenization. This includes the global real estate market, the global equity market, the global debt market, and countless other liquid assets. Tokenizing even a fraction of this would represent the single largest capital market evolution in history. This is BlackRock's vision. They see a future of unparalleled market efficiency, where ownership can be transferred frictionlessly and liquidity can be unlocked from assets that have been historically illiquid. But here lies the core of their implicit warning. The infrastructure that powers our financial markets today, the exchanges, the clearinghouses, the settlement systems like the DTCC, were built for an analog T+2 settlement world. They are fundamentally, technologically, and architecturally incapable of handling a 24/7 real-time, globally interoperable market of tokenized securities. Imagine trying to run a modern supercomputer on the electrical wiring of a 1950s house. The system would instantly overload and collapse. This is the crisis that the financial world is quietly facing. They are architecting a future of tokenized assets with no viable, scalable rails to run them on. This creates a desperate, system-wide need for a new foundational layer, a new settlement protocol that offers speed, security, regulatory compliance, and the ability to handle trillions of dollars in daily transactional value. The warning from BlackRock is not just that tokenization is coming. It's that the world is woefully unprepared for the infrastructural demands it will create. This vacuum is where the opportunity for a project like XRP becomes not just compelling, but essential. The breaking point: why legacy rails and even first-gen blockchains will fail. The prophecy of a tokenized world is exciting, But the practical reality is fraught with immense technical challenges that most observers underestimate. The reason BlackRock's vision is also a warning is because the existing financial plumbing is destined to break under the strain of this new paradigm. But it's not just the old systems that are inadequate. Even many first-generation blockchains are ill-suited for the task. Let's first consider the legacy systems. When you trade a stock today, the settlement process is a complex, multi-day affair involving clearinghouses and custodians. It is slow, costly, and carries significant counterparty risk. Trying to settle trillions of dollars worth of tokenized assets through this archaic batch processing system is a non-starter. It will negate the entire purpose of tokenization, which is to achieve real-time settlement and efficiency. So, the natural inclination is to look towards blockchains. But here we encounter another set of problems. A platform like Bitcoin, with its proof-of-work consensus, is far too slow and energy-intensive to handle global asset settlement. Its primary use case is as a store of value, not a high-throughput transactional layer. What about a smart contract platform like Ethereum? While revolutionary for DeFi and NFTs, it faces its own set of critical hurdles for institutional-grade RWA settlement. The gas fee model is volatile and unpredictable, making it nearly impossible for a financial institution to forecast operational costs. During times of network congestion, a simple settlement transaction could become prohibitively expensive. Furthermore, while Layer 2 solutions aim to address scalability, they can introduce their own complexities regarding fragmentation of liquidity and settlement finality. For a bank settling a multi-million-dollar trade of a tokenized bond, probabilistic finality is not acceptable. They need absolute deterministic and rapid settlement. This is the critical breaking point. The world needs a ledger that offers institutional-grade performance, massive throughput, thousands of transactions per second with low, predictable costs, rapid, deterministic finality, settlement in seconds, not minutes or hours, with 100% certainty, built-in compliance features, the ability to handle regulated assets in a way that satisfies AML, KYC, and other regulatory requirements, a neutral bridge asset, a native digital asset that can serve as a trustless intermediary to settle trades between a vast array of different tokenized assets, from a tokenized U.S. Treasury bond to a tokenized share of a European company. This is a stringent set of requirements for the settlement layer of a tokenized world. It is a filter that eliminates the vast majority of existing blockchain projects. The warning from BlackRock and the reality of the market is that a highly specialized solution is required. This is where we must turn our attention to the specific design and strategic positioning of the XRP ledger. XRP, the purpose-built settlement layer for a tokenized world. It is no accident that the XRP ledger is uniquely positioned to answer the infrastructural crisis posed by BlackRock's tokenization prophecy. Unlike general-purpose blockchains that have tried to be a jack of all trades, the XRPO was designed from its inception with a singular, profound purpose in mind: to be the world's most efficient institutional-grade settlement layer for value. To be prepared as an investor is to understand how every feature of XRP and its ecosystem is meticulously aligned with this mission. First, let's consider its technology. The XRP ledger's consensus protocol does not use proof-of-work or proof-of-stake. It uses a unique federated consensus mechanism that achieves transaction finality in 3 to 5 seconds. This is not probabilistic, it is deterministic. When a transaction is confirmed on the XRPL, it is final, immutable, and settled. This level of speed and certainty is precisely what institutions require for settling high-value trades of tokenized assets. Furthermore, the transaction costs are negligible, fractions of a cent, and they are predictable, allowing institutions to accurately model their operational expenses. This solves the gas fee problem that plagues other smart contract platforms. Second, the XRP ledger has a built-in decentralized exchange DX. This is a critical, often overlooked feature. It allows any asset issued on the ledger to be traded against any other asset, including XRP itself. In a future where you have thousands of different tokenized assets, stocks from different countries, various bonds, real estate tokens, a native, efficient exchange is essential for providing liquidity and facilitating seamless exchange. XRP is positioned to be the primary neutral bridge asset on this DX, a common denominator that can be used to settle trades between any two tokenized assets, regardless of their origin or underlying value. This bridge currency utility is a massive source of its fundamental demand. Third, and perhaps most importantly in a post-2024 world, is XRP's unprecedented regulatory clarity in the United States. Following the landmark settlement with the SEC, XRP stands as one of the only major digital assets with a clear legal status as a non-security. For institutions like BlackRock, Fidelity, and the major banks, regulatory compliance is not just a feature. It is the absolute prerequisite for any serious engagement. They simply cannot and will not build long-term, multi-trillion-dollar strategies on an asset with an ambiguous legal status. XRP's clarity gives a profound first-mover advantage in attracting this conservative institutional capital for tokenization securities and other real-world assets within the U.S. market, the largest financial market on Earth. Finally, consider the strategic moves made by Ripple, the primary contributor to the XRPL ecosystem. Their acquisition of decode provides the institutional-grade custody solution that banks need to securely hold these new tokenized assets. Their development of a compliant, dollar-backed stablecoin, Rust, will provide the perfect on-ramp for fiat liquidity. Their deep engagement with central banks and regulators globally ensures that their solutions are built in alignment with future financial policy. When you connect these dots, a clear picture emerges. The XRP ledger isn't just a blockchain. It is a purpose-built settlement engine for the tokenized economy that BlackRock and Larry Fink have warned us is coming. Its speed, cost efficiency, built-in DX, and most critically, its regulatory clarity make it the leading contender to serve as the foundational settlement layer for this $600 trillion market transition. The on-chain evidence in Ripple's RWA strategy. While the macro vision laid out by BlackRock is compelling, the truly informed investor looks for tangible evidence that the preparation for this tokenized future is already happening. The secret is not just in the vision, but in the execution. And when we look at the on-chain data for the XRP ledger and the strategic moves from Ripple, the evidence of this preparation is clear and undeniable. Let's begin with Ripple's explicit strategy regarding real-world asset RWA tokenization. They are not just waiting for it to happen. They are actively building the tools and forging the partnerships to make the XRP ledger the primary venue for it. Ripple has been investing heavily in enhancing the XRPL's native tokenization capabilities. The existing XLS20 standard for NFTs is just the beginning. Their work on a native automated market maker, AMM, for the DX is designed to provide deep, decentralized liquidity for the thousands of new tokenized assets that will be issued. They are building the financial plumbing before the water starts to flow. Furthermore, Ripple's partnerships are increasingly focused on this RWA narrative. While their work in cross-border payments continues to expand, we are seeing new, strategic collaborations with asset managers, real estate firms, and commodity traders who are looking to tokenize their holdings. These partnerships are often quiet and start as pilot programs, but they represent the crucial first step in bringing trillions of dollars of off-chain value onto the XRP ledger. For example, recent pilot programs in Asia and the Middle East have focused on tokenizing trade finance assets and carbon credits on the XRPL, demonstrating its utility beyond simple payments. The on-chain data provides further corroboration. While difficult to pinpoint every specific RWA transaction, we can observe broader trends. We are seeing a steady increase in creation of new trust lines for non-XRP assets on the ledger, indicating that more participants are preparing to hold and transact with new tokens. We are also seeing a significant increase in complexity and value of transactions utilizing the ledger's more advanced features, such as escrows and partial payments, which are essential for complex financial agreements involving tokenized assets. Most importantly, Ripple's acquisition of decode for institutional custody is the linchpin of their entire RWA strategy. Institutions will not tokenize billions in assets without a secure, regulated, and battle-tested way to store them. By integrating decode's technology, Ripple can now offer an end-to-end solution to a bank or an asset manager. We will not only provide you with a ledger to tokenize your assets, the XRPL, but we will also provide you with the institutional-grade vault to securely store them. This is an incredibly powerful and comprehensive value proposition that very few other projects can match. This isn't just about building a faster blockchain. This is about building a complete, enterprise-ready ecosystem for the tokenized world. Ripple is strategically assembling all the necessary components: the fast and compliant ledger XRPL, the neutral bridge asset for settlement XRP, the secure custody solution Medico, and the compliant fiat on-ramp, the upcoming Relust. The evidence is clear. Ripple is not just hoping to participate in the tokenization revolution. They are positioning XRP to be at the absolute center of it, the $600 trillion equation, and what it means for XRP holders. So, we arrive at the final, most critical part of our analysis. What does all of this, BlackRock's warning, the coming tokenization tsunami, and XRP's unique positioning as the ideal settlement layer, actually mean for XRP and for those who hold it? This is where we connect the macro vision to the fundamental value of the asset itself. This is the $600 trillion equation. It is crucial to understand that in this new paradigm, XRP's value will not be primarily driven by retail speculation, but by utility-driven demand for settlement. Imagine a world where just a small fraction, let's be conservative and say 1%, of the estimated $600 trillion in global assets are tokenized and actively traded on various ledgers. That's $6 trillion in tokenized value. Now, these assets will need to be settled. When a tokenized stock is traded for a tokenized bond, or when tokenized real estate is sold for a stablecoin, that transaction needs a final, irrevocable settlement layer. If the XRP ledger, due to its speed, low cost, and regulatory clarity, captures even a small percentage of this global settlement volume, the demand for XRP as a neutral bridge asset would be astronomical. To facilitate trillions of dollars in daily settlement value, the network would require an immense amount of liquidity. This doesn't necessarily mean that all $6 trillion will be converted into XRP, but that a significant amount of XRP would be needed by market makers, liquidity providers, and financial institutions to facilitate these rapid conversions and settlements. This creates a powerful supply and demand dynamic. The total supply of XRP is finite. As more and more of it is utilized and held by institutions to provide liquidity for the settlement of tokenized assets, the available circulating supply for the open market will shrink dramatically. This is the concept of a utility-driven supply shock. It's not about people hoarding a speculative asset. It's about the asset being actively used and locked up as essential financial infrastructure. This is what BlackRock's warning truly implies for XRP. They are signaling a future where the value of digital assets will be inextricably linked to their role in this new tokenized economy. An asset's value will be a function of the economic activity it secures and settles. In this world, an asset like XRP, designed for high-volume, low-cost settlement, is positioned to capture a value that is orders of magnitude greater than what is reflected in its current market price. To be prepared as an XRP holder is to understand this equation. It is to prepare for a future where XRP's price is not determined by daily market sentiment, but by the GDP of the digital economy that it helps to settle. This isn't about wishful thinking. It's about understanding the fundamental mechanics of a market that is undergoing a once-in-a-century transformation. BlackRock, Larry Fink, and the world's largest financial institutions are not just watching this happen. They are making it happen. They have warned us what is coming. The question is, are we listening? Subscribe to CryptoStand and activate the notification bell. The information we share is designed to prepare you for the greatest capital market evolution in our lifetime. This is not the time for speculation. It is the time for understanding. Join us, and let's decode the future of finance together.